What in your experience is the most difficult term for an entrepreneur to accept? Where do they really say, "Look, come on, I'm not signing up to that"?
The one that usually shocks entrepreneurs are the lever provisions and the good lever, bad lever, the whole treatment of founders' shares. Because say, an inexperienced entrepreneur or founder believes that they own their shares and they will always own their shares unless and until the company is sold or they sell their shares. But the way that a typical venture capital transaction is structured is that the investor is investing on the basis of that entrepreneur staying with the company and driving the company, and because the venture capital investor is investing in the team and the founder, and so the venture capital investor wants to ensure that the founder and the entrepreneur stays with the company. And the mechanism for doing so is through having a lever provision, a reverse vesting of the founder's shares, so that if the founder does leave, then there is a penalty for leaving, and the investor effectively is indirectly compensated for that founder leaving.
Are you saying basically to be a good leaver, you have to be dead?
Well, there is the expression that the only good leaver leaves the company feet first in a wooden box. Yes, but there's a lot of nuances here, and particularly, a lot of it does depend upon also the maturity of the company, because you can imagine if the company is, say, brand new, 6 months old, there may be it may be more acceptable to the founder to say, okay, granted, so I've only had this company for 6 months, and you're already placing a 10 million pre-money valuation on the company. Yes, I will stay with the company for 4 years, and I will earn back my shares. Um, but when the company is, say, 7 years old, and a new investor is coming in and is requiring the founder to relinquish some of the economic rights to those shares, that becomes a bit of a harder bargain, because the entrepreneur has already been with the company for a significant period of time. And let's be honest, usually for most founders, the vast majority of their net wealth is tied up in the equity of the company. And so there's a debate that goes on as to, well, of course, I, as the founder, the entrepreneur, am not going to leave the company because my net worth is tied up in the company. But on the other hand, the investor wants to ensure that there is that form of a golden handcuff between the company and the founder.
But in founder shares, do you typically see accelerated vesting in the case the company is sold or there's a liquidity event during the vesting period?
Absolutely, absolutely.
Does that also apply to employee options, ESOPs? Do they accelerate?
It varies from jurisdiction to jurisdiction, and also the size of the company, to be honest, and the amount remaining in terms of how much of the option may remain unvested. But I think fundamentally what it comes down to is, what is the buyer buying, and in a typical venture capital transaction, um, in an exit scenario with a trade sale, the buyer is going to be buying not just the technology, but the management team. And the buyer does want to ensure that the management team is not only properly compensated for the work that they've done historically, but also incentivized going forward, and is going to be retained going forward. And I think you then have to sort of square the circle between ensuring that the founder does receive a reward for the work that they've done to date, but then is still uh, retained by the company and is incentivized to stay with the company post acquisition. So typically, there is some form of either a top up or some sort of retention package that the buyer will offer to the management team.
We cover a couple of other things. So drag rights, in my experience, are quite controversial. Do you want to talk to us about about that. So you have, in the case of drag rights, you have essentially a minority shareholder, the VC investor, kind of controlling when, how, and to whom the company is going to be sold. That's what it looks like, isn't it, to the entrepreneur?
Yeah, I mean, if you just look at it black and white, that's absolutely correct. It is the opportunity of the VC investor to force a sale of the company. Now, from the if you look at it from the investor's perspective, because as we said a few minutes ago, the venture capital investor is investing to get a return on their investment, and they have, because of their limited partner agreements, they have a specific timeline by which they're expected to return money to their own investors. There does have to be a mechanism for the venture capital investor to force an exit, because the VCs, as I said before, they're not charities, but nor do they invest in lifestyle companies where they expect the investment to last for 20 years or something like that. So the drag along mechanism is very important. However, having said all of that, you've got to look at a little bit of the real world and what a typical VC-backed company is about, which is about the management team, about the founder, about the entrepreneurs in the company, and the technology that the company has. And so it's going to be relatively difficult in most situations for a venture capital investor to sell a company to a trade buyer against the wishes of the management team or against the wishes of the founder and the entrepreneurs who founded the company, because a trade buyer isn't going to be interested in some sort of reluctant
Yeah.
founder.
Are you arguing, Chris, that it has to be there because that's a requirement for the VC to be able to provide a return to their LPs? But in practice, what it's there is to force a dialogue between the investor and the entrepreneur as to how you exit. Is that your argument?
It's a little bit of both, to be honest. I don't mean to be sort of sitting on the fence there, but from a legal perspective, it's required to ensure that you do not have a stray or maverick minority shareholder holding up a deal. Because the last thing that you want to have is a company with, call it, 100 shareholders, and 99 of them want to sell the company, but the one holdout doesn't want to sell, and that one holdout could only have a handful of shares. You don't want the entire transaction to fall over because of that one shareholder. And so, therefore, you do need to have a mechanism in place to force that one shareholder to sell. Now, there are in various jurisdictions, there are statutory structures that it will enable that shareholder to be forced out. But having a legal and contractual construct helps facilitate that. It's a bit of a stick that you can use on that one shareholder. But that also does create that opportunity for the VC investor to have a stick to also have that dialogue with the founders in terms of a potential sale of the company. Now, sometimes when we are acting for the founders, what we try and do is have a two-tiered approach to the drag, so that it's not just the VCs that are able to implement the drag, but it's that you also require the consent of the founders. So it's the founders and the investors can force all of those minority shareholders to sell. That then ensures that there has to be a dialogue, because you need the consent of both in order to trigger the drag.
I also wanted to ask you, Chris, about convertible loan notes, where the investor is coming in some kind of debt instrument. Why would an investor do that? What are the advantages or what are the consequences?
10, 15 years ago, a convertible loan note was the easiest way for an investor to make an investment into an early stage company, and was probably the most used instrument in terms of making that initial investment into a company. The reason why that was so dominant was because a convertible loan note is a very simple legal document that allows an investor to make an investment into a company without having to negotiate the vast majority of the equity terms that you find in an institutional investment, where like a Series A investment, because you are effectively procrastinating or deferring any sort of debate and discussion regarding the valuation of the company, a liquidation preference, or any of the commercial terms regarding the investment. The convertible loan note is essentially ensuring that the investor is able to receive equity in the company at some later date in the future. The debt component is intended to ensure that there's some downside protection in the event that the company is either liquidated or sold before the note actually converts.
If you put your convertible loan note in at a price per share of one, and then the equity is priced later at a valuation of 10, haven't you lost out on some gain in the valuation of the equity?
In theory, that is right, and that uh, loss of valuation is compensated through either the valuation cap or the discount, because the discount is meant to reflect the risk profile of the company at the time of between the investment or the time that the convertible loan note is executed, and the conversion, and then combined with the interest rate to the convertible loan note, um, you then are able to effectively reconcile that. That early stage of investment, and you don't necessarily get the exact valuation because you don't know what the valuation of the company is at the time of the execution of the convertible loan note, because with early stage companies, the valuation of the company is a finger in the air exercise for the most part.
You mentioned you started out by saying that was what it was like 10, 15 years ago. So how is it different today?
Today, most early stage investments in the United States, and becoming more so in Europe, are executed by way of a SAFE. SAFE stands for Simple Agreement for Equity. And that is an instrument that was developed actually by my colleagues at Orrick, together with the folks at Y Combinator, which is an instrument which is, I would say, it's analogous to a convertible loan note without the debt. It's a convertible security that is like a prepayment for the investment at a later date. And there's no interest component, but what it is it does provide a discount to the next round of financing, or there is a valuation cap that is placed upon that conversion. So there is some protection to the investors to ensure that when the instrument converts, it's not converting at a significantly higher valuation than what would typically be expected, and so the investors have that sort of, call it, upside protection, that they are not diluted significantly as a result of a future equity investment at a much higher valuation.
Chris, you're talking about all these clauses or terms that an investor could put in to protect the downside and to give them a better position, give them some control. But how does that work with future rounds? Aren't they themselves risking being punished because that will encourage future investors also to put in fairly aggressive terms?
That's absolutely true. One of the biggest challenges for companies is ensuring that you have a strong foundation in the terms of your initial investment, because it's human nature, and particularly amongst investors who may not necessarily be human, but it's certainly uh, uh, par for the course for subsequent investors to build on and pile on additional terms, that if the earlier stage terms are draconian in nature, well, that can only get worse in subsequent rounds of investment. Um, no investor in the right mind is going to accept lesser terms than a prior investor, unless the company is on a tremendous trajectory that more often than not, what's going to happen is that the subsequent investors are going to say, ah, if the previous investor got that, then I'd like some of that too. And so here are my terms plus one or what have you.
Chris, very interesting hearing your perspective. Before we finish, is there a resource that an entrepreneur can go to learn more about what's happening in Europe in terms of venture capital investment? I think your firm publishes something that might be interesting.
Yes, we publish a resource called Deal Flow, and Deal Flow 4.0 will be coming out in either the third or fourth week of January of this year, and that will provide a good overview of how term sheets have looked over the course of all of 2023, and it goes on or it reviews on a term by term basis the various components of a term sheet and how those have been reflected in more than I think we've got about two or 300 venture capital transactions that we've done in Europe in the past year. We also have a dedicated website called Orrick Tech Studio, which is a terrific resource of form documents, but also articles and various other guides to things such as founder shares, liquidation preferences, and provides sort of a layman's guide to a lot of these terms and peels back the curtain in terms of a lot of these issues that are unique to the technology ecosystem.
Okay, let's get personal here. Is that what kind of budget should I allow for my legal fees if you're going to advise me as an entrepreneur raising my A round?
I think fundamentally what it comes to is in a venture transaction, the legal fees have to be proportionate to this to the amount of money being raised, and firms such as Oric are very flexible in terms of adjusting the fees in light of the amount of money being invested. It makes absolutely no sense for a significant portion of the monies being raised to go to pay legal fees. So firms like Orrick and other Silicon Valley based firms have a business model which is predicated on a long-term relationship with a venture capital backed company. Our business model is not just simply advising a company on a single transaction, but it's much more about advising a company on the Series A, the Series B, the Series C as the company matures, but also handling such things as advising on the stock option plan and employment advice and intellectual property advice. And if there's any patent litigation, things along those lines because Orrick is a full service law firm for companies in the technology sector. It's all of the other ancillary legal matters which are important to a technology company that we're capable of advising on.
Chris, thank you very much for your time today. Very instructive, very helpful. Thank you.
My pleasure. And if anybody has any questions, please feel free to reach out. I'm happy to have a chat.